You know what nobody's talking about right now? The fact that silver stackers, the people who've been quietly accumulating physical metal for years, are suddenly changing their behavior in ways we haven't seen since 2011. And I'm not talking about small shifts. I'm talking about a fundamental change in how they're positioning themselves, and it's happening right now, in real time. Let me show you what I mean. Over the past 6 weeks, something unusual started happening at coin dealers across North America. The typical silver stacker, your average person buying maybe 10 to 20 ounces a month, suddenly started placing orders for 500, 1,000, even 2,000 ounces at a time. These aren't wealthy investors. These are middle-class Americans who've been saving for years, and they're now converting everything they can into physical silver. One dealer in Texas told me he had a customer who liquidated a rental property just to buy silver eagles. Another in Ohio said a retired couple cashed out their entire money market account, $180,000, and walked out with silver bars. This isn't panic buying. This is something different. This is conviction. And here's what makes it significant. These stackers have been in the market for years. They've seen silver drop from $30 to $18. They've watched it bounce around $20 for what felt like forever. They've been patient, methodical, adding to their positions month after month. But now they're accelerating. They're going all in. And when the most patient, most disciplined buyers in the silver market suddenly shift into high gear, you need to pay attention to what they're seeing. Because they're seeing something the mainstream financial media isn't covering. They're seeing the setup for what could be the most explosive move in silver's history. And it's not based on hope or hype. It's based on cold, hard supply and demand fundamentals that are reaching a breaking point. Let me take you inside what's really happening. Start with the physical market. The United States Mint sold more silver eagles in the first quarter of this year than any quarter since 2015. We're talking about 14.3 million ounces in just 3 months. But here's the kicker. They had to ration sales to dealers because they couldn't keep up with demand. The Royal Canadian Mint? Same story. They're running weeks behind on orders. The Perth Mint in Australia actually suspended some product lines because they couldn't source enough silver blanks. Now you might think, okay, retail demand is strong, but that's always been the case with silver. And you'd be partially right. Silver has always had a passionate retail following. But what's different now is that retail demand is colliding with an industrial demand surge that's unlike anything we've seen before. Solar panel manufacturers are consuming silver at a rate that's growing by 15% year over year. Electric vehicles use twice as much silver as traditional cars. 5G infrastructure requires massive amounts of silver for its conductivity properties. And here's the thing nobody's calculating correctly. These aren't cyclical demands that will fade. These are structural, long-term demands that are only going to increase as the world electrifies. Last year, industrial demand for silver hit 539 million ounces. Total mine production? 830 million ounces. Sounds like there's plenty of supply, right? Wrong, because that mine production number is misleading. About 70% of silver comes as a byproduct of mining other metals: copper, lead, zinc, gold, which means silver production doesn't respond to silver prices the way you'd expect. When silver prices rise, miners don't just dig more silver. They're digging for copper or gold, and silver comes along for the ride. And here's where it gets interesting. Copper production is plateauing. Many of the world's largest copper mines are aging and grades are declining. That means less byproduct silver even as industrial demand is exploding. We're heading into a structural deficit that could last for years. But the stackers aren't just looking at supply and demand. They're looking at something deeper. They're looking at the monetary system itself and seeing cracks that are getting harder to ignore. Think about what's happened over the past 3 years. The Federal Reserve printed more money from 2020 to 2022 than in the entire previous decade. The M2 money supply, that's the measure of all the dollars in circulation, expanded by 40%. 40% in 2 years. And now we're supposed to believe that inflation is under control because it dropped from 9% to 3%? The stackers aren't buying it. They're looking at their grocery bills, their insurance premiums, their property taxes, and they're seeing the real inflation rate. They're seeing that the dollar's purchasing power is eroding faster than the official numbers suggest. And they're moving their wealth into something that can't be printed, can't be debased, can't be inflated away. Silver, throughout history, has been the people's money. Gold was for kings and governments. Silver was for everyday transactions, for workers, for savers. And right now, silver is repricing itself against a currency system that's losing credibility by the day. Look at what's happening internationally. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to reduce their dependence on the dollar. They're settling trade in their own currencies. They're accumulating gold at record rates. And while gold gets the headlines, silver is quietly being accumulated too. China's silver imports have been running at elevated levels for months. India's silver demand hit a record last year. These aren't speculative moves. These are strategic moves by nations that see the writing on the wall. The dollar's dominance as the world's reserve currency is being challenged in ways it hasn't been since Bretton Woods collapsed in 1971. And when that system broke down, gold went from $35 an ounce to $850 within a decade. Silver went from $1.50 to $50. Now, I want to pause here for a second because if you're sitting on $100,000 or more in retirement accounts, this is probably relevant to you. I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical precious metals into your retirement account without triggering tax penalties. It's worth checking out if you're thinking about protecting your retirement savings with hard assets. All right, back to where this is headed. The stackers are also watching something that most investors don't understand: the paper silver market versus the physical silver market. See, most silver trading happens on the COMEX, the Commodities Exchange in New York. And on the COMEX, you can trade silver contracts that represent 5,000 ounces each. But here's the thing. Most of those contracts are never settled in physical metal. They're cash settled. It's paper trading paper. The total open interest in silver futures on the COMEX often represents more than 800 million ounces of silver. But the actual registered silver, the silver that's available for delivery, is usually around 50 to 80 million ounces. That's a ratio of more than 10 to 1. 10 paper claims for every ounce of physical silver. Now, as long as everyone's happy trading paper, the system works fine. But what happens when people start demanding physical delivery? What happens when the stackers, the industrial users, the investors all show up at the same time asking for real metal? We got a preview of this in 2020 and 2021. Premiums on physical silver exploded. You had silver trading at $25 on the COMEX, but try to buy a silver eagle and you were paying $35 or $40. The spread between paper and physical blew out to levels we'd never seen before. And that was just retail demand. Imagine what happens when industrial users start getting nervous about supply. There's a term in the silver market, a short squeeze. It's when the people who've sold silver they don't have, the short sellers, suddenly have to buy it back because they can't deliver. And silver is one of the most heavily shorted commodities in the world. The big banks, the commercial traders, they hold massive short positions in silver. They've been doing it for years, using those positions to manage risk, and some would argue to suppress prices. But those short positions are like a coiled spring. The more they build up, the more explosive the move when they have to cover. And right now we're seeing signs that the spring is getting tighter. Commercial short positions have been declining over the past few months. That means the big players are covering their shorts, buying back silver to close out their positions. When the smart money starts covering shorts, it's usually because they see something coming. They're getting out of the way. Meanwhile, the Commitment of Traders report, that's the weekly report that shows who's positioned where in the futures market, has been showing something interesting. The managed money traders, the hedge funds and speculators, they're not heavily long silver right now. In fact, their positions are relatively modest compared to historical levels. That's significant because it means there's a lot of room for new buying to come in. When silver really starts to move, those traders will pile in, and that's when you get the parabolic moves. Let me give you some historical context. In 1979, silver was trading around $6 an ounce. By January 1980, it hit $50. That's an 8x move in about a year. What drove it? A combination of inflation fears, geopolitical instability, and yes, the Hunt brothers trying to corner the market. But the underlying driver was a loss of confidence in paper currency. In 2008, silver dropped to $8 during the financial crisis. By April 2011, it was at $49. Another 6x move in less than 3 years. What drove that? Quantitative easing, zero interest rates, and a flood of money looking for real assets. Now look at where we are today. Silver's trading around $30. We've got inflation that's structurally higher than the Fed wants to admit. We've got geopolitical tensions that are escalating, not de-escalating. We've got a monetary system that's being questioned by major economies around the world. And we've got supply and demand fundamentals that are tighter than they've been in decades. The stackers are looking at this setup, and they're seeing 2011 all over again. Except this time, the fundamentals are stronger. The industrial demand is more structural, the supply constraints are more severe, and the monetary backdrop is more unstable. But here's what really has them excited. the gold to silver ratio. This is the number of ounces of silver it takes to buy 1 ounce of gold. Historically, that ratio has averaged around 60 to 1. Right now, it's around 85 to 1. That means silver is cheap relative to gold. Very cheap. When that ratio is high, it tends to compress. Silver outperforms gold. And when silver starts outperforming gold, it doesn't do it gradually. It does it explosively. In 2011, the ratio went from 80 to 1 down to 32 to 1 in less than a year. Silver more than doubled while gold was also rising. The stackers are betting that we're at the beginning of another ratio compression. They're betting that silver is going to play catch-up to gold in a big way, and they're positioning themselves now, before the mainstream figures it out. There's another factor at play here that's easy to overlook. Sentiment. Silver has been in a bear market or a sideways grind for most of the past decade. It's been frustrating, boring, and largely ignored by mainstream investors. And that's exactly the kind of environment where the best opportunities are born. When everyone's excited about something, when it's on the cover of magazines and your neighbor's talking about it, that's usually a sign you're late. But when something's been beaten down, forgotten, dismissed as a relic, that's when the smart money starts accumulating. And that's exactly what the stackers have been doing. They've been buying when silver was $18. They've been buying when it was $22. They've been buying when it was $25. They've been building positions while everyone else was chasing tech stocks and crypto. And now, as the fundamentals are aligning, as the supply-demand picture is tightening, as the monetary system is showing cracks, they're accelerating their accumulation because they understand something that most investors don't. Silver is both an industrial metal and a monetary metal. It has dual demand. And when both of those demand sources are strong at the same time, the price doesn't just rise, it explodes. Think about what happens when industrial users start getting nervous about supply. They start building inventory. They start securing long-term contracts. They start bidding up prices to make sure they can get the metal they need. At the same time, if investors are worried about inflation, about currency debasement, about financial system stability, they start buying silver as a store of value. Those two demand sources feed on each other, creating a feedback loop that drives prices higher. And here's the thing about silver. The market is small. The entire annual silver market is worth maybe $25 billion. That's tiny compared to gold, which is a $200 billion market. It's microscopic compared to the stock market or the bond market, which means it doesn't take a lot of money flowing into silver to move the price significantly. If just a small percentage of the money sitting in stocks or bonds or real estate decides to move into silver, the impact would be enormous. We're talking about a market that could double or triple just from a modest shift in asset allocation by institutional investors. The stackers know this. They've studied the market. They've done the math. They understand that silver is one of the most asymmetric bets available right now. The downside is limited. Industrial demand provides a floor. But the upside? The upside is massive if even half of what they're seeing plays out. Let me give you a specific example of how tight the physical market is getting. There's a company called Sprott Physical Silver Trust. It's a fund that holds physical silver in vaults, and investors can buy shares that represent ownership of that silver. Over the past year, Sprott has been buying silver aggressively to meet investor demand. They've added tens of millions of ounces to their holdings. But here's what's interesting. When Sprott goes to buy silver, they're not buying paper contracts on the COMEX. They're buying physical bars from the London market, from refiners, from wherever they can source it. And they've reported that it's getting harder to find large quantities of silver available for immediate delivery. Lead times are extending. Premiums are rising. The physical market is getting tight. Now multiply that across all the different buyers in the market. The mints producing coins, the industrial users manufacturing products, the ETFs accumulating metal, the stackers buying bars and rounds. Everyone's competing for the same finite supply of physical silver, and production isn't keeping up. This is the setup the stackers are seeing. This is why they're shifting from steady accumulation to aggressive buying. They're not waiting for confirmation. They're not waiting for silver to break out to new highs. They're buying now, while it's still under $35, because they believe that once this move starts, it's going to be fast and it's going to be big. And there's a psychological element to this that's important to understand. The stackers have been ridiculed for years. They've been called tin-foil hat types, conspiracy theorists, doomsayers. They've watched their silver holdings go nowhere while stocks went up and up. They've endured the skepticism, the mockery, the doubt, but they never sold. They kept stacking. And now, as the fundamentals are finally aligning, as the market is finally starting to recognize what they've been saying all along, there's a sense of vindication. There's a sense that their patience is about to be rewarded, and that conviction is driving them to go all in. This is the big shift. This is the moment when the stackers go from defense to offense, from accumulation to aggressive positioning, from waiting to acting. And if they're right, if the supply-demand fundamentals play out the way they expect, if the monetary system continues to lose credibility, if industrial demand keeps growing while production stagnates, then we're looking at a silver market that could see prices we've never imagined. Some analysts are talking about $50 silver. Some are talking about $100. The more aggressive ones are talking about $200 or higher. Are those numbers realistic? I don't know. But I do know that silver has a history of moving in ways that shock everyone. I know that the fundamentals right now are as strong as they've been in decades. And I know that the stackers, the people who've been in this market longer than almost anyone, are positioning themselves for something big. So the question isn't whether the stackers are entering a big shift. They are. The question is whether you're going to pay attention to what they're seeing, or whether you're going to wait until silver's at $50 and everyone's talking about it before you start paying attention, because by then, the easy money will have been made. By then, the stackers will have already captured the bulk of the move, and you'll be buying at prices that are multiples of where we are today. The shift is happening now. The stackers are moving. The only question is whether you're going to move with them or watch from the sidelines.